The Shannon School of Business Small Business Development Center is pleased to present Entrepreneurs in Action, a series of short videos designed to help clarify some of the issues that affect the business owner and may sometimes be a challenge. Developed by the business professors of Cape Breton University and featuring successful entrepreneurs, these videos provide viewers with the ability to ask the right questions of themselves and others to get the answers they need in order to succeed.
I was excited when I was asked to develop the material for the video on finance because I know how important finance is when you start a business or when you try to grow a business. All businesses start small, even the big ones, even General Electric or Bell Canada, they all started as small businesses. And what made them great, it was because they knew how to market their product and service, and they also knew how to finance their startup, and they knew how to finance their growth. The biggest source of failure in startups, if you look up the stats, the biggest source of failure in startups is undercapitalization, not enough capital. And this is what we try to do in the finance module. We try to go through the basics about the two big decisions that managers have to make. How do you decide where you're going to invest your funds, what assets you're going to invest into to make the highest return, the best value for your business's dollars? And the second decision is then, once you decide that, how much money you need to do this, then how do you go about raising the capital, how are you going to finance the startup of the company, and once you grow, again, how are you going to finance that? Are you going to go through debt? Are you going to go through equity? How are you going to do that?
For years, the term finance was often confused with accounting, but now things are a whole lot clearer. Finance is all about making financial decisions for your company, while the job of accounting is to keep score, to tally up the results of those decisions. This video is all about the all-important role of finance in the life of your company and your role as a leader who can make informed and valuable financial decisions. For now, let's assume that you have a great business idea and some sense of how marketing works. Without a good grip on the financial implications of how you make and how you market that great idea, you may never make it past go. To operate a successful business, a business that makes a profit, two important decisions have to be made, and they both concern company assets. It's kind of like a 1-2 punch. First up, how you buy and use assets in order to gain the highest possible return on your investment, and secondly, how you raise funds to cover the purchase of those assets at the lowest possible cost. This is the essence of wise corporate finance. A 1-2 punch for success. Every business needs to buy or lease assets like equipment and furniture. These are your capital assets. The other kind of assets are current assets. Inventory, cash, supplies, accounts receivable, when a firm is owed money for services performed, and deposits on utilities. Both kinds of assets require some serious coin. Moolah, do-re-mi, capiche? So, you'll want to invest in assets that help your company generate revenue far in excess of your capital costs. Keep in mind that insufficient funding is a major cause of business failures, so it's a bad idea to underestimate your initial startup costs. Let's assume that your business plan has clearly identified your capital requirements and includes a detailed cash flow projection. The cash flow projection will attempt to predict all the funds that your business will receive and spend within a given month, quarter, or year, and establish a surplus or a deficit. At times, the cash inflows will be exceeded by the outflows, and vice versa. For example, you might project very good sales in December, only to be followed by a lean and mean January. In this way, your cash flow projection will highlight your net cash position or free cash flow. This last line, cumulative cash position, is what every entrepreneur needs to focus on, because the net income figure that your accountant produces by subtracting expenses from revenues won't pay employees or vendors. They only work for cash. So like a car without gas, a business cannot operate long without cash. The cumulative cash position is your fuel gauge. Let's take a closer look. It's important to keep the spreadsheet as simple as possible and understand the relationship between business strategy and finances. What happens if pricing and sales volume are lower than projected? Adjust your strategy. What happens if growth is too slow or too fast? Adjust your strategy. What kind of price and sales volume figures will result in positive cash flow and net profit? Adjust your strategy? You bet. By learning how to create and use the cash flow projection, you can answer these questions and many more, and adjust your financial strategy accordingly. And here's the big news. The cash flow projection also gives you two other important financial gauges that every entrepreneur needs: your projected income statement and projected balance sheet. The accounting module of our Shannon School of Business video series will provide you with the detailed information you need in order to develop and understand these three important financial statements. And there are many software packages that can help you prepare cash flow projections, including customized tools available free on various bank websites. Meryl Carmichael is a partner in Venture Solutions of Point Edward, Cape Breton, and provides a range of services to business startups. Meryl, can you talk about the importance of finance when considering a new company startup?
The importance of financing on a startup of a new company is critical. If you consider the business as a vehicle, the financing is effectively the fuel that'll run that vehicle. And you need to have a strategic plan in place which encompasses all the various aspects of the operations of a business, which include operations, marketing, sales, human resource, and capital acquisitions.
Could you discuss cash flow projections?
Cash flow projections are critical. They need to be done at the outset. It's what tells you how much financing you're going to need based on the projections you do for sales, which are the piece where the money comes from, and then to pay the expenses that you're going to be incurring to hopefully generate a net income at the end of the day by having sold more than what you spent.
Can you describe some source of startup money?
A lot of businesses start out with personal savings, money from friends and family, and then it moves along to private investors as you grow, or angels, they call them. And there's an organization called the First Angel Network that you can try and get in front of. Wealthy family funds, there's seed funds available, venture capital funds.
Thanks, Meryl. Financial planning sounds like sound advice coming from you. Now, for a change of pace, let's take a mathematical journey to discover the amazing break-even point. Here's our cash flow projection again. Successful entrepreneurs want to know what sales volume will be required for any new venture to hit break-even. The break-even point is the level of operation at which the total costs equal the total revenue. The break-even point is important because it indicates when a business can begin to make a profit and how profitable the business can be. You can determine the amount of sales dollars you will need to reach the break-even point by using a simple formula. Let's assume that fixed costs are projected at $250,000. Selling price of product is $80 per unit. Variable costs are $60 per unit. Contribution margin per unit is $80 minus $60 or $20. 250,000 divided by 20 equals a sales target of 12,500 units. Your break-even point in dollars is equal to the total fixed cost divided by the gross margin, which equals 1 million in sales volume. Have you ever heard someone say, "We make 20% on sales"? The problem with this statement is that it's wrong. There is no percentage of profit in a sales dollar until all fixed costs of the business are covered. It is essential that you determine the break-even point for your business before you move on to seek out lenders or investors. And that brings us to startup money, your initial capitalization. When you're building a new company brick by brick, the motor that holds it all together is money. The major sources of financing for small business startups are your own pocket, friends and family, banks, credit unions, government programs, and venture capital. You should be able to piece together the debt and equity funding you need from a mix of these sources. Let's consider them one at a time. Obviously, the first place to look for money is your own pocket. This may mean cleaning out your savings account and other investments, selling your second car, pushing your credit cards to the limit, taking a second mortgage on the cottage, and looking under the cushions on the couch. Additional funds may come from your friends, family, and significant others. This is known as love money. It's been suggested that love money makes up more than 90% of Canada's new business startup capital. Once you have a significant amount of your own money or love money in the form of loans or share equity, you may be able to interest banks and other sources in the financing of your venture. Bank loans are debt financing, money that must be repaid, usually in monthly or quarterly payments with interest. Equity funding is money supplied in exchange for shares in your company. Equity investors do not need to be repaid, but they expect to share in the profits your business will generate. They will usually demand a voice in how your business is run, and they expect to be able to sell all or part of their investment before too long at a considerable profit. And it's good to keep in mind that a 30% rate of return is considered healthy for investing in new ventures. If we go back to our earlier business model, we can see that a $500,000 equity investment would have to return a profit of $150,000. By modifying the break-even formula, we can quickly show that sales would have to reach $1,600,000. And that's why most new businesses are wise to grow carefully until they can justify seeking out equity investors. Remember, every financing strategy commits the company to a different path with different costs and different possibilities for future financing options. One more thing. Make sure you can secure the capital you need before starting your business. It usually takes 6 months or more to identify and lock down financing. And if you're facing short-term cash flow shortages, you won't look very good to investors. To give us his perspective on financing strategies, let's get Merrill Carmichael back on screen for some more Q&A. Merrill, can you talk about the advantages and disadvantages of debt and equity financing?
Most entrepreneurs have a very high value of what they're doing versus a third-party investor looking at it has a significantly different view of what a company may be worth, which then in turn it becomes a simple exercise in mathematics of what's it worth versus how much do you want to give up, and this is what we're prepared to pay you.
Why is the cumulative cash position so important?
Cumulative cash position is accumulation of money coming in and going out on a monthly basis or weekly or annual, but most businesses will generate a cash flow projection on a monthly basis so that the items that generate cash, your sales, whether the cash coming in could be sales, bank loans, investor contributions or loans, versus what goes out, your expenditures, loan repayments, expenditures for capital. The plus and the minus, the money coming in versus the money going out is either plus or minus, and then you carry that through from month to month. And most people hope that it's on the plus, the black side, as opposed to being in the red.
Can you talk about the advantages of a friendly local banker?
It's about developing a relationship with the banker. I find in my years of dealing with the various bankers in the local area especially, if you have free communication and free disclosure of information and you continually let them know when if there's a problem on the horizon, to give them advance warning. My biggest experience has been, as long as you give them a heads up, they're willing to work with you. Having the banker come to your organization, come to your place of business so that they can see what you're doing, and you can, it makes them feel involved and as a partner, and I think that's probably the biggest way to maintain a friendly relationship with a banker.
Thanks again, Merrill. You've been a great help. In time, your new business will need to obtain both debt and equity financing in order to produce growth and still allow you to keep a healthy stake in your company. Which brings us to the matching principle, not a dating site, but a common sense approach to financing assets. Try to match short-term funds to finance current assets and long-term funds to buy capital assets. You wouldn't use a credit card to buy a house, and you shouldn't use a line of credit to buy equipment. Short-term debt, like a line of credit, is usually used by a business for working capital and is repaid out of proceeds from sales. Long-term debt in the form of loans is used to finance the purchase of assets, with the assets serving as collateral for the loan. As we mentioned earlier, there are many sources of debt and equity financing, but keep in mind that all lenders like to see some equity invested in a startup before extending any loans, and many of the sources of equity capital are not available until the company matures. Generally speaking, a new venture can get debt financing for working capital which is equal to the equity that you and your BFFs have put into the business. The sources for this are the banks, Canada Business Development Corporations, trade credit and leasing companies. As companies mature, a huge range of equity options will become available, including wealthy businessmen, also known as angels or perhaps dragons. Venture capital, which usually comes with a 5 to 10 year involvement, corporate venture capitalists who look for young high-tech companies to reduce the costs of their own research and development. Public venture capital funds from federal and provincial governments, which are managed by crown corporations and government agencies. Community economic development funds, employee stock ownership plans, worker cooperatives, and if your company seems headed for a $20 million sales figure after 5 years in business, there's the initial public stock offering, or IPO. Since the cost of setting up an IPO typically exceeds $1 million, it's usually an option for only certain high innovation, high growth companies or large mining and resource companies. A word to the wise, choosing a bank, and more specifically a banker, is probably the most important decision a young entrepreneur will make. Ideally, you should choose to do business with a banker who understands your industry. This person will most often make a quick and sound evaluation. To qualify for a loan, you must have sufficient equity in your business and a strong personal credit rating. Well-developed business plans that spell out the sales estimates, market niche, cash flow, profit projections, and plans for growth are essential. Bottom line, it's the ability to repay both interest and principal on time that matters. Parting thoughts. Successful entrepreneurs cultivate close working relationships with their bankers and take an active role in keeping them informed. In addition to monthly and annual financial statements, bankers should be sent news releases and trade articles about the company and invited to visit your offices or plant to review the prospects for your business. Most importantly, inform your banker of any bad news about your company. Being upfront and honest can often lead to loan adjustments and a willingness to help out. The business world is a whole lot more complicated than a family fund board, but the objective remains the same. Enjoy the game and play to win.